Hi, IBD. I'm Meredith Heyman. This is IBD Explains. Thanks so much for joining me. After cutting rates three straight times in 2024, the Fed is now trying to ease its monetary policy and aiming for a neutral rate in 2025. But what exactly is a neutral rate and what does it mean for investors? Joining me to break it all down is IBD News editor Ed Carson. Ed, thanks so much for being here. Let's get right into this. The neutral rate is the Fed's big focus for the year ahead. What exactly is a neutral rate?
Well, a neutral rate is basically a rate that neither restricts nor propels economic growth. So it's a moving target. So it's not easy to spot, but it's like the Fed doesn't really is getting a situation where it doesn't really want to be, putting the brakes on the economy or speeding it up. And so it's trying to get to neutral, but it isn't quite sure where it is.
Some economists think it's around 4.25% or 4.5%. Others believe the neutral rate is closer to 3%. Where do you think the neutral Fed rate falls?
I don't know where it is. To be honest, and it is interesting because, as you say, some people think we're basically at neutral now because the Fed funds range is 4.25 to 4.5. Notably, though, Fed Chief Jerome Powell at the last Fed meeting said the Fed is not quite there yet. The neutral rate is still clearly below the current policy rate, so that would suggest that the Fed would still be cutting rates in 2025, which the Fed did suggest it would be doing at that meeting.
So figuring this out is kind of a guessing game based on what's happening in the economy. What are some of those macro factors that influence this?
Yeah, I mean, a lot of it is like inflation expectations. It could be demographic shifts. It could be, government policies. A big one is productivity growth. Productivity growth plus the increase in the population or the working age population. That's sort of generally viewed as almost free growth. This is how much you can grow. There's no concern about inflation. But other times, if the economic growth is very inflationary, so the rate might rise. So if we have a real AI boom and there's a productivity boom, we might grow really fast, and the neutral rate might be pretty low because inflation won't take off. Other times, it might be higher. So it definitely moves quite a bit. I think it had been quite a lot lower for quite a while, and we've had interest rates pretty low over the past couple of decades because inflation wasn't out of control. And I think just obviously now, part of its inflation expectations, the neutral rate seems to be a lot higher than it was.
And how will the inflation rate, tax cuts, and a bigger deficit impact this number?
Yeah, I mean, if you think of the tax cuts, if you think tax cuts will create some kind of productivity enhancing investment boom, then maybe you think that that could lower the rate to some extent because you're going to have higher productivity. If it just fuels consumption and doesn't provide a whole lot of boost there, then you might be thinking higher budget deficits that might think that some of it's going to be inflationary. So that's part of what's going on with, the Fed has been talking, with policy uncertainty along with, the Fed probably getting close to being neutral. So the Fed is trying to grope for that last bit. It's sort of like when you're inching forward, like when you're trying to inch forward to get a little bit further with your car. Can you go a little further, a little further? You get much more nervous than when you're a long way away. When you're going for that last bit into the parking space, you really slow down. And that's where I think the Fed is a little unsure where to go.
And what will Trump's new administration mean for determining a neutral rate and the Fed's approach overall?
It's a challenging look. The Fed made it clear that it's wondering about policy uncertainty because President Trump is thinking about a lot of big policies. There's tax cuts, there's tariff hikes, there's deregulation. There's a lot of different things that could do things that might be inflationary, that might not be inflationary. Depends on the mix of it. Deportations. There's a lot of things out there. So I think the Fed which was already probably going to be in a wait and see attitude. They've cut rates a bunch in 2024. They're probably going to say, well, where are we? How are things? Inflation hasn't really come down yet. So they were probably already going to be waiting. But as I say, when you add to that a lot of uncertainty about the size of various policies and when they'll come out, it just makes things more uncertain, makes the Fed probably want to just stand back and wait to see, because, to see how that affects the economy, how that affects the neutral rate.
Finally, Ed, what will the potential for a neutral rate mean for investors and the stock market?
I mean, honestly, if the neutral rate is higher, that means that the Fed and interest rates probably need to be higher to slow things down. And generally higher yields are bad for the stock market on a few reasons. One is that you can compare it to bond yields, stocks, to bond yields and, a safe return on bonds, quote unquote. People discount future growth, so growth stocks often take a hit if yields are higher because you use the higher discount rate. And it also means that investment is higher. Like, the stock market is all about investing. And so if you're talking about all these companies making investments, they need a rate of return that's higher than, what the interest rates are. And the neutral rate plus whatever, you're adding on to it, that might be higher than we've had. And real interest rates might be higher than they were for 20 plus years. And so those could be potential headwinds for the stock market.
All right, Ed, we'll be watching. Thanks so much for joining me. This is IBD Explains. I'm Meredith Heyman. Stay right here on IBD for more. We'll see you next time.